Okay, the first slide I want to put up, which is an oldie but a goodie. This here is actually a, oops, hold on. Yes, okay. So this here is a daily news article going back to, if you can see the date there, October 10th, 2008. October 10th, 2008. And what's really neat about this, and I don't frame every article I've done, not that I've done tons and tons, but I've done a bunch. The one reason I have this one framed, and this is the only, I believe the only daily news article I have framed, at least in my home office. It's one of my favorite ones. It was in, as we can see here, 2008. And what's significant about 2008, of course, was that was the last time we had the type of sell-off that we're seeing right now. So I thought it was really apropos for what's happening today. But what I found to be really interesting, I think, is my response. So this here is the article, right? Framed and, darker hair, a little less gray than I have today and all this. But this here section that you probably can't read here, but the one that I highlighted here, I snapshotted, and here it is, okay? And if we just take a moment and read this is exactly what I said in 2008. It's exactly what I said in 2001, for those of you that have been clients for that long, and some of you have. And it's exactly what I'm saying today, right? But this came out of that article from 2008. So I thought that was pretty cool to put up on the screen here. And it really encapsulates everything that we believe here at Sovereign, which is, in short, monies that you need in the short term should always be in safe funds, high quality short-term bonds, CDs, money markets, and so on and so forth. And funds that you don't need for the longer term could and should be aggressive, because that's really going to be the growth engine. And what's important for us is to always be in sync to make sure that we at Sovereign understand what your cash flow needs are, and specifically how much do we feel you're going to need to withdraw and when. And that derives our buckets, which most of you have with us. I mean, most of our clients that we work with, we have in the bucket system. I think probably something like 90% of our clientele is in this particular system. And I just think it's the best way to do it. And it's generally divided by monies that you need in the real short term, like about 1 or so years. And that should be in cash. Then we have our 2 to 5 year portfolio, 6 to 10, 10 plus. And this really is the cornerstone of everything that we do at Sovereign. And then that drives our money management. So the short-term funds, certainly if you look at those accounts that are tagged 2 to 5 or short-term, however we have them tagged for you, those are going to be down a lot less, if at all, in this particular market. And of course, the long-term funds, we certainly have seen them down, although they're down about, maybe 10% less than they were yesterday. And for a lot of you that are tagged, and we have funds that we know you don't need for 10 years and you have the right risk tolerance, we actually bought some yesterday, which was certainly a good time to have done that. So I thought this was a good way to start off this presentation. And kind of under the category, the more things change, the more things stay the same. This has always been our philosophy. And it really is as simple as understanding how much money do you need and when, and then short-term funds should be safe and firewalled, and longer-term funds can and should be invested for growth. Buying on these types of dips. Was yesterday the bottom? Who knows? But we know it was 35% less than it was, about a month ago. So it's certainly a good entry point for funds that are not needed in the short term. Okay. Little talking. Remember, I did this presentation yesterday, or at least I put together this deck for yesterday. And I was trying to give some context of what was happening with the market, right? So the market trading, certainly over the past week or so, at least, started off trading because of the virus and uncertainty, but really the trading over the past few days in particular has been very correlated to what's coming out of Washington, right? The news from Washington. So this was yesterday. So yesterday is when I refer to here overnight, pretend this was yesterday. So Sunday night, for those of you that, put on CNBC Asia, 6 p.m. Sunday night, as John and I do almost every weekend, every Sunday night, you could watch the futures. And it's usually a pretty good determination on how the market's going to open. So Sunday night, this was written on Monday, keep in mind, Sunday night, the market was limit down. And limit down, which is unfortunately a term that a lot of us probably know now, limit down means that the circuit breakers have kicked in, and boy, the market wants to sell even more, but the circuit breakers have stopped it. That usually means limit down, there's going to be more selling as soon as those circuit breakers open up. So the market Sunday night was limit down. Oh my gosh, it's going to go down another 5-10%. Then Monday morning, yesterday morning, the Fed made unprecedented announcements, right? not this morning, this was done yesterday, Monday morning, and they were truly unprecedented, right? So we perhaps recall the idea of QE, quantitative easing, from back in 2008-9. That is the Federal Reserve just pumping money into the system, and that helps buoy up the markets. What's unprecedented with the announcements that came out yesterday morning, really two things. One, that it's now unlimited. It's like nothing we've ever seen before. In the past, they would announce, $500 billion, 200, whatever it was a finite dollar of money that they're going to commit for this quantitative easing. But what they've done now, as of yesterday, is say it's going to be unlimited. Whatever it takes, the Fed will pump money into the system. Very good. Number two, and this also has never, ever happened. It didn't happen in 29. It didn't happen in 2008-9. It has never happened. And that is the idea of the Fed actually buying corporate bonds, not just treasury bills and bonds, but corporate bonds. That has never happened. That is an incredible move. And to take that even one step further under the category of things that have just never, ever happened was the idea that the Fed was going to buy corporate bond ETFs. And there was even whispers of the Fed buying stocks, and that's never, ever happened. But with this type of rally that we saw today, who knows if it's going to continue, but certainly if it does, I don't think that will ever happen. But certainly the Fed has made the commitment to stand behind the markets and help as best they can to buoy this up. You guys might remember the Bernanke put. That's the same sort of idea where the Fed chair is saying, look, we are going to try to help stabilize these markets as best we can with the resources that they have. And the good news is the resources that they have are frankly pretty significant. And then the market recovered, right? So going back to the timeline. So Sunday night, market was limit down. Monday morning, the Fed announced all these great unprecedented announcements. The market recovered. Then what happened later in the day on Monday? This is yesterday, right? So Congress could not agree on an aid package, and now the market goes back down again. Again, demonstrating here how closely correlated the news from Washington has been impacting the markets, right? So the Fed made the announcement. We're happy. The market goes back up. The Congress can't agree on an aid package. The market goes back down. And then that brought us to later in the day on Monday. And again, I was planning on presenting this yesterday at 4:30. Later in the day yesterday, Congress was getting close to finalizing the aid package, right? We all saw that on television. And then the market went back up again. And then, of course, that second vote on the aid package failed and the market went back down. Complete correlation to what's coming out of Washington, and in particular right now, falling upon the shoulders of Congress with the hopes that they will all get together and put together the aid package that people, let alone the economy, really, really need. I gave away the next slide there. Hopefully you didn't see it. But fast forwarding to this morning, right? I didn't update the slides here, but we all saw what happened. Just on the belief that Congress will finally get this aid package together, based on that belief, the market has not only gone up, but has given us the biggest up day that we have seen ever, well, at least since 1933. So we feel pretty good about that. So this next slide, I think Bob and Martin in particular, this one is for you guys, for everyone, but you guys in particular perhaps. One of my favorite expressions from one of my favorite characters from history, Winston Churchill. And you can always count on Americans doing the right thing after they've tried everything else. I think that's just a funny expression, perhaps true, some of the times at least, and certainly applicable in this particular context. So that's where we stand right now. I'm going to take just a moment here to look at the Q&A because it looks like we have some come in, and let me see what we have. Let's see here. Just bear with me. Okay, the first one here. If this is so unprecedented, this is from Martin. If this is so unprecedented, then how can it be compared with 2008? Okay, so with regards to how unprecedented this is, and I think you're referring to the Fed actions. What is happening with the Fed right now that's very different from 2008 are those two things. Number one, the fact that they're going unlimited. They're not saying, here's how much we're willing in dollar terms to commit to this, but rather, we're going to put in whatever money it takes until this thing is stabilized. So it's an open-ended promise to just keep pouring money into the market. And the other part that's, I think, even more interesting perhaps, is the fact that they're going to be putting money into corporate bonds, which has just never, ever happened. And I think pretty good. And we've seen that in the corporate bond market. Okay, so I'm going to check that as answered. But if there's a follow-up, please just keep posting them up here. I'm going to just go in order. Okay, bear with me as I figure out the system here. Okay. All right. Okay. This is from Anthony. Can you share your thoughts on the impact of programmatic trading, right? The algos, we call them, the algorithm trading, and market volatility. The way I like to describe those folks, and what Anthony is referring to here, are people that trade based on algorithms and computers. So there's these really complex algorithms, really essentially a chain of what if functions, right? So if the market does this, we're going to trade this way. If this particular stock does that, we're going to trade this way. If this economic indicator, let's say the jobs report, whatever, comes out in a certain way, we're going to trade this way. What I believe and have always believed about these algorithmic traders, which are computer trading, robo trading, whatever you want to call it, is that they amplify the volatility in the market. I'm not sure if it's necessarily good or bad, but it will take swings that might be, for example, today, a 10% swing, biggest we've seen since 1933. And perhaps without the algos, it might have been a more subdued trading, but I think the direction would be pretty similar. So I think unless you're a day trader, which I'm certainly not a day trader, we don't really have clients that are day traders. I don't think it's a good idea to be a day trader. But I think the algos really impact those high frequency or day traders probably more than the type of investing that we all do here at Sovereign. Okay. Next one here is a question from Marie. What are the similarities and differences between this market and the market in 2008? Excellent question. 2008 was, as I think a lot of us know, driven by a financial crisis, like a true financial crisis. This is, of course, being driven initially, and this is where kind of starts to look like 2008, in my opinion. It was initially a health scare, and still is, a very real and serious health scare. But now that's starting to permeate into an economic situation, right? We hear about those auto loans. Everyone's talking about the auto loans being similar to the low-quality home loans in the past in 2008, and I think that's not inaccurate. I think that is pretty accurate of a comparison. So it is possible that this health scare can impact the economy so much that it causes the same type of economic damage that we saw in 2008. However, and this is purely an opinion of mine, but I do really believe this, assuming we can get this whole virus thing under control, and I have to believe we have the capability of doing it once we put our minds to doing it, and not just coming up with a vaccine or something like this, which of course would be awesome, but just doing the things we need to do, the social isolation, preventing the real widespread contamination, cross-contamination, whatever you want to call it. I think if we could do that, then as deep and powerful as this economic setback will be, I think it'll be fairly temporary compared to 2008. Now, if this goes on much longer, it's going to have, I think, longer-term economic consequences that could start making this look more and more like 2008-9. So to answer your question, that's probably the best I could do. I mean, who knows? We'll find out in a month or two how under control this virus is and how quickly things get back. One thing I will share, though, probably more anecdotally, just for myself. So I'm pretty involved with some associations, the Financial Planning Association in particular, I've gotten very involved with. And we had a number of conferences and events scheduled for this spring. All of those have been canceled, of course. And now we are clamoring to try to find event space in the fall. And again, this is anecdotal, but interesting. We can't find any space. Everything is booked. So it's my belief, and it is certainly my hope, that if this is under control by then, which we all hope that it will be under control, I really think there's a huge amount of pent-up demand for business activity, for things like conferences. That's going to require restaurants and hotels and conference space, of course, but also just general entertainment, right? I mean, I could tell you we had to cancel our spring break plans. So we have thousands of dollars worth of airfare and hotel credits, burning a hole in our pockets that we all want to start using. And I think and certainly hope that once we get the all clear on this, then we can move on to start spending that money and living our lives more normally. And I think they'll have a very positive impact. Okay, got a lot of questions here. I'm going to take a few more and then go back to the deck. And again, bear with me as I try to figure out the best sort of cadence for these types of presentations. Hopefully everyone is finding this useful, but I figure we'll do some questions, maybe a handful, and then go back to the presentation deck. Okay. This one's from Fred. So I talk about 2 to 5 and 10-year money. What happens to planning in years 6 to 10? That's included in that concept. So a lot of times I'll just say the 2 to 5 and 10 plus just for brevity. But of course, most of our plans have 1 year in cash, 2 to 5 in short term, 6 to 10 and 10 plus. That was just an omission just for brevity. But for sure, the 10 plus is going to be our most aggressive portfolio for most people, for everyone that we do that system with, which is most clients. Cash, of course, is the most conservative. 2 to 5 would be more aggressive than cash, I suppose, but still very conservative. And of course, 6 to 10 would be somewhere in between. Okay, Fred has another question. Yep, why not use stop losses? Actually, Fred and I talked about this offline today, and I asked him to bring this up. I'm not a big fan of stop losses. For those of you not familiar with what a stop loss is, a stop loss is an actual, it's like the almost the opposite of a limit order, right? So a stop loss is an order you could place saying if the stock market goes down to a certain level on the way down, okay. And more importantly, an individual stock or an ETF in our case, because we really don't do too many individual stocks. But once it hits a certain low level, it will automatically start to try selling. Pet peeve of mine is the name stop loss. It really should be, in my opinion, called a stop loss start. Because what really happens with those orders is once it hits a certain level, it will start to try to sell. So it doesn't mean you sell at that price. So let's say we use a fictitious ETF trading at $100. You want a stop loss at 80 to hopefully stop the loss. If it starts drifting down from 100 down to 80, at 80, it will turn into a market sell, which means it will try to start to sell at 80, but it could still drop down more, and you could end up selling at 75 or 70 or who knows what. So it doesn't mean you will actually get out at that price. All a stop loss means is you will start to try to get out at that price. Why I don't like that? Because it really is, in my opinion, akin to market timing. So let's say you do have a stop loss, you get out here, when are you going to buy back in? Will you miss out on that? And I'm going to leave on that note because I got some great slides that speak to that particular point, I think very, very well, under the category of the dangers of market timing, trying to pick bottoms and tops. And we'll talk about that at length in just a moment. Okay, so I'm going to put the questions on hold for just a moment and go back to the deck and then come back to them and resume. But I think we're getting a good handle on some of these questions. Okay, so let me just look on my cheat sheet here on what's coming up next. Okay, good. So this here is a good slide. We get these from Morningstar. And what this slide will show us are some of the major market downturns and the recoveries from 1926 up until present. And as you can see, the real big one here, and I've got some follow-up information on that. Move my picture screen out of the way. Was, oops, there we go. All right, so this is the Great Depression, right? So 1929 to 32. So the sell-off was somewhere in the neighborhood of 83% down, and the recovery took 151 months. Huge amount of time. I've got a slide, right after this that I want to show everyone that I think shed some light onto that. But other than the Great Depression, most of those recovery periods are much less than that, right? About 3 years, 5 months, 7 months, 10 months. Oops. As you can see here, the largest one next to the Great Depression was 2001 to 2002, right? That took about, 49 months to recover. What's interesting is the 2000, can you see that? I have a lot of these things in my way. Yeah, there it is. So the 2007 to 2009, which we kind of call the Great Recession, everyone clearly remembers that. That took less than 3 years to heal itself, right? And then the one we saw in Christmas Eve day, and we actually bought stock on that day as well, for those of you that have 10-year plus money with us. Excuse me. Back on that day, and John and I remember that very well because we were pretty busy, but for accounts that we had for clients that were tagged as 10-year plus money and aggressive, we bought stock on that particular point in time on Christmas Eve day, and that was a very quick V-shaped recovery. I don't certainly anticipate that happening with what we're seeing here today or this period, but it's nice to see that something that was pretty troubling at that time. If you guys remember, the market was down 20% that month. It does come back. But let's talk about this real long one, right? Because this is what everyone would fear. And I think this would be a pretty reasonable worst case scenario, people comparing what's happening now to the Great Depression. And maybe it will cause a Great Depression. I mean, I certainly don't know that for sure. I don't think it will. But let's even say that it does. And this is the idea of firewalling and segmenting short-term funds from intermediate-term funds to long-term funds. So this particular event, right, the Great Depression, took 150 some odd months to recover, okay? But did it. And here's what I mean by that. This is a great article, and I wrote a blog post about this article probably about a year ago, and I'll send everyone who's on here today a copy of that or a link to that blog post. But this was posted by the New York Times, reliable source, most people would agree, back in April of 2009, the last time we were all really concerned about all this market pullback then. The question was, did it really take 25 years for the Great Depression stock market to bounce back? Their contention is no, it took closer to 4.5 years. And I'll leave you guys to read that there. But basically what it's saying is, if you look at all the real factors, purchasing power, dividends, and the allocation of that particular index, it really, realistically, did not take 25 years for it to bounce back. It was probably closer to 4.5, maybe 5 years. And here's a breakdown of that article. So if you look at it, and I'm just moving these things around so I could see, the three factors that have obscured the truth from this particular notion that it took, years and years for the market to bounce back in 1929 was the idea of deflation, right? Because it was looking at nominal values, not inflation adjusted values, which when you have a great deal of deflation, as you certainly saw in the Great Depression, you have to account for that. Dividends, most of our stocks pay dividends, and most of our accounts, certainly our less aggressive ones, focus on high dividend paying stocks. We love dividends. And if you don't account for the dividends, I think you're missing a big part of the picture. And certainly looking at the recovery period for the Dow Jones in just nominal terms without dividends precludes you from really seeing the reality that it was certainly bad, it was certainly horrible, but maybe didn't take a couple of decades to recover. And the last one here, and this is what the New York Times commented on, and I agree with, is the distinction between the Dow Jones average, which is just 30 stocks, and the overall stock market. And as you can see there, and some of you may be surprised, because frankly, I was surprised about this, because I didn't know this until I read this article, over a decade ago. But somehow, in 1939, someone removed IBM from the Dow Jones average. They put it back in the 1970s. So if you took out IBM from the Dow Jones had an even harder time recovering, because IBM actually had a really great period of time after that. And removing it really impacted the results. So that speaks to a couple of things, in my opinion. Number one, the idea that, the Dow Jones is not a great index to look. We like the S&P, we like the broad markets even better. But it also is the idea of stock selection and missing out on one or two stocks. So if you have the wrong stock or if you have the right stock, it's going to have a huge impact on your portfolio. What we try to do is even out those returns by having diversified portfolios. That kind of lowers the up and down side and gives us, hopefully over time, a more predictable rate of return. As I say here, I'll send out a link to everyone that's on here with a link to that blog piece that I write about this article. And that blog piece actually has a link to the article itself. I think it's worth a read if you're interested. Okay, let me move on to the next slide here. You know what, actually, let me take a moment and go back to some questions. I know that seems like the right thing to do here. And after this, I'm going to ask for feedback if you guys like the idea of doing questions as we go through or, all at the end. Okay, let me just scroll down here. Okay. If you are in or close to retirement, this is from Joanne, and you realize your cash level should be higher, is it too late to sell stocks or funds? Okay. Yeah, now Joanne, I must say also is not a client, because if she were, this would be a conversation we would have had 2 or 3 times a year for the past 5 years. I really can't answer that question, Joanne, because I don't know your personal situation. I'm going to encourage you to reach out to me separately, offline. I'd be happy to look at it. But I can tell you the ideal would be to make sure you have enough in short-term funds, whether it's cash or high-quality short-term bonds, to always meet your relatively short-term needs, depending on how risk-adverse you might be. So that's got to be at least 1 year, preferably 2 to 5 years is kind of where we put that range. So to say you should sell your stocks now to raise cash without knowing your full situation, I certainly can't do that. But I am happy to review your situation. If you want to reach out to me later today or tomorrow, I'd be happy to spend some time. Here's another question. This is from Suzanne. Should someone who retired recently panic about their portfolio? Okay. I don't know. I don't know which Suzanne this is, so I can't tell if this is one of our Suzannes. We have a few Suzannes as clients, or if it's a non-client Suzanne who joined us as a friend of a friend type of thing. But I can tell you, if you're one of our clients and you've spoke with me within the past 6 to 12 months, which all of you have, every conversation, every review meeting that I have with clients will always start and end with how much money do you need and when do you need it? It is just that important, to the point you might be getting sick of it, but it's just such an important thing to always ask, to make sure there's enough money in non-stock market vehicles to satiate whatever cash flow needs you might need in the short and well, at least the short term. And how you define the short term is really going to be driven in some part by your own personal risk tolerance. So short term for some really aggressive people might be 1 or 2 years. Short term for really conservative people might be closer to 3 to 5 years. There's no right or wrong answer, but somewhere within that range, I think makes some sense. Okay. Let me just go through this here. How do you decide which corporate? Okay. All right. This is a question from Michael. How do you decide which corporate bonds to buy, or do they buy in a bucket? Okay. Excellent question. So every firm is going to have a different philosophy on this. I can speak to what our philosophy is at Sovereign. If it's a high quality bond, we will buy those individually because there's really no default risk, right? So back when rates were higher, we would very easily and often put together a laddered bond portfolio of individual high quality bonds. Now, if we're talking about bonds that have more yield, right? The higher the yield, the lower the quality, right? If my hands are making it on here, the higher the yield, the lower the quality. So those are going to be anywhere from intermediate grade corporate bonds or junk bonds, which junk bonds, of course, has kind of a negative name, junk, but it's not a bad category as part of a diversified portfolio. But with junk bonds or high yield bonds, which is the more euphemistic way of referring to a junk bond, for junk bonds, we do like to have those in diversified buckets, ETFs, mutual funds. And the reason for that is if you're going to put X number of dollars to junk bonds, we want to split that up amongst as many different junk bonds as we possibly can to help mitigate the risk inherent in that type of market. So the best way we can answer that question, for high quality bonds, we will hand select individual bonds. For lower quality, meaning higher yielding bonds, we will always use an ETF or some sort of mutual fund. Okay, I'm going to pause some of the questions for now just to move on to the next slide. And this here, and let me move my tag out of the way. Okay, so this slide here, crisis of long-term performance. And what I like about this particular slide, and this is one from Morningstar that we use quite often, just giving it a quick look. You know, if we were to all kind of say, what is the trend of this particular line? And of course, this line is for the stock market. The trend is up, right? The trend is up. So if we were to say long-term, what do we think the market's going to do? Well, if you ask me, long-term, the market's going to go up. Short-term, I'm always concerned and nervous about the market, now about as much as ever. But long-term, I'm still very comfortable with the market. And each one of those periods of time, whether it's the oil crisis, the stock market crash, the dot-com crash, the banking and credit crisis, fill in the blank, right? Any one of these crises at the time felt horrible, felt like we were never going to get through it. But of course, long-term we did. And the problem people had is not so much having the markets go down and back up again, but really the problem lies in the idea of the market going down and then someone not having the cash flow planning in place and then needing to take money out of the stock market, similar to that one of our more recent questions, having to take money out of the stock market at a point when the market is down. And that's called sequence of return risk. And in a couple of slides, we have some really good information about that. But that really is what I'm concerned about. I'm not so concerned about markets going down or up, because long term, I do believe they're always going to go up over the long term. What I'm concerned about is the market going down for an account that someone needs in the next year or 2 or 3. If that's the case, then there's a problem, because that person will now have to withdraw money from an account while it's corrected. And now you've realized those losses, and that money ain't never coming back. That's the issue that we're always working on as we're doing our financial planning discussions and cash flow management discussions with clients. And that speaks again, as I've said many times, even in just this presentation, the importance of our always being in sync with clients with regards to how much money you need and when do you need it. So that's a nice slide for that. Now, here's another interesting one. And this speaks to, I think it was Fred that mentioned earlier about our 6 to 10 year portfolio. For those of you that are in one of our discretionary 6 to 10 year portfolios, if you look at your allocation, it's about 40% bonds, 60% stocks, okay? Right now, our 6 to 10 year portfolio is actually flip-flopped, and it has been. So there's actually 60% bonds and 40% stocks, give or take, right? Give or take a few percentage points for everyone's unique risk tolerance and all this. But that's our 6 to 10 year portfolio. But let's even say it was even more aggressive, right? This one here is 40% bonds and 60% stocks. Again, much more aggressive than our current 6 to 10 year portfolio. And our 2 to 5 year portfolio only has about 20% in stocks. But take a look at this. And these are real numbers, right? Real numbers. For a portfolio that's 40% bonds, 60% stocks, that is being regularly rebalanced, right? I stepped closer to the microphone to be sure that everyone hears that, because that's important, to regularly rebalance those portfolios. But let's take a look. So if we look at the crash in 1987, okay, a 40-60 portfolio, the red is 1 month, the yellow is 6 months, the green is 1 year, the, I don't know, what is that? Dark blue, I guess, is the 3 year, and the light blue, which is the one I want to focus on, is 5 years. So a diversified portfolio, 40% bonds, 60% stock, which is more aggressive than our 6 to 10 year portfolio right now, over all these different periods of time, the 87 crash, the S&L crisis of 89, the long-term capital crisis in 1998. If those of you remember that, I know I certainly did. We thought that was like holy Christmas. The dot-com crash, we all remember that one pretty good. The 2001, of course, the terrorist attack, and then the 2008. But if you look at each one of these, forget about the red, which is the 1 month, or the yellow, that's the 6 month, or the green, that's 1 year. Look at the 5 year. After every one of these really catastrophic events, both in history as well as the stock market, within 5 years, the market rebounded. Let me see if I can get like a highlighter here. I apologize, I don't quite know how to do that. Hopefully you guys could see this. Hold on, let me see if I can find that, because I think that would be helpful here. Yeah, I'm getting my muscle memory up to speed on this presentation software. I know there's a way to do it. Just give me a moment. If not, I'll move on, but it would be nice to have this. Nope, I guess not. Yeah, sorry about that. I was practicing this before. That's one thing I didn't think to practice. So hopefully you guys can see this. But if I could draw your attention to the blue marker. So all the way to the left-hand side, that's the one that shows 90.1%. What this is showing is this is the return of that portfolio. Again, a 40% bond, 60% stock portfolio during a really difficult period of time after 5 years. And as you can see here, during every 5 year period of time, you are able to not only recuperate the funds of that loss, but walk away with some pretty nice profits. So that's the idea of having the right type of allocation for the right time horizon. And that's really what we're trying to demonstrate with that particular slide. Okay. One last thing I want to talk about, actually 2 more before we go to Q&A, and I'm going to end the presentation on sequence of return risk, which is kind of the grand finale. I think one of the most important concepts we could talk about here today. This next one here is the idea of market timing. I love this idea as well because, you know, whenever the market has these gyrations, and we've certainly seen some very serious ones over the past couple of weeks, I don't get a lot, but I definitely get some questions. Should we just sell everything and buy back in when things are calm? How do we do that, right? I mean, I have no way of knowing when the selling is really going to stop. So when you try to market time, you have to be correct on the way out of the market and then correct on the way back into the market. And that's just impossible, right? And there's so many different slides we have. I just picked this one here. This one is from 1997 to 2017. But if you look at any real period of time, any 5, 10, 15-year period of time, you're going to see similar outcomes. And I really wish I had that highlighter working here. Give me one more second. I'm going to see if I can find that. No. Yeah, I apologize. I didn't think about that until kind of just recently. Let's see if there's any other way for me to look up how to do that real quick. No, sorry. So, okay, I'll walk you through this. So if you look, I'm looking at the top bar graph over to the far left where it says 7.2%. So that is if you had your money just fully invested in the stock market and left it alone for that period of time of 1997 to 2017, and you just left it alone, and that would be 5,217 trading days. You would walk away with an average rate of return of 7.2%. Not bad. But look at that next one over, at that 3.5%, that first green bar on the right of that. If you miss just 10 of the best days, if you miss just 10 of the best days of 5,217 days, if you miss just 10, your return is 3.5%. That's ridiculous. I mean, how could anyone imagine that they're going to possibly be able to pick the right handful of days, almost 2 handfuls of days, to not miss out of 5,217 days? You can't do it, in my opinion. I know I can't do it. I don't believe anyone can do it. I do believe there's people that think they could do it. And I know there's people that have tried to do it, but I've never seen anyone successfully do it. But just think about that. And again, it's not just this period of time, 97 to 17. You could really look at just about any 5 or 10-year period of time, and the numbers are amazingly similar in that if you miss just literally a handful of days per 1,000, right? A handful of days. These are not even just calendar days. These are the trading days. If you just miss a handful of trading days per 1,000 days, your return is substantially lowered. Okay? Let's look at this slide here. This shows each year from 1970 to 2019, right? So this gives you maybe a better look. And the dark blue, I guess, or the dark green represents the annual return period, full stop. And the light green is going to be the annual return minus the one best month, right? So this is missing the best month out of a year. And as you can see consistently, if you miss just the best month of any of these years, and these are all the years from 1970 to 2019, your return is substantially lower on the upside, and your loss is substantially greater on the downside, bar none. So I think that's worth really keeping in mind. I'm just kind of checking here. Yes, the next set of slides are going to be on sequence of returns. So I'm going to go back and do a few Q&A. And again, that just feels like the right thing to do. Please, after this presentation, I really would appreciate any feedback. If you guys like the Q&A, breaking up the slides, or would you rather me just power through the slides and do all the Q&A at the end? So whichever you want to do is fine with us. We'll kind of take a consensus. Okay, let me just look at a few more of these questions. Let me just see here. Oh, that one's done. Okay, Jill asked a question here. If corporate buybacks don't get addressed, how will that impact the stock market? Okay, so Jill, what I think you're referring to there with all this aid package coming through from Congress, one of the concepts is they don't want to have, or there's people that don't want to have corporations use this money to buy back stocks. I think that's what you're referring to. So that's the whole idea of a moral hazard, right? We're hearing that term again. We certainly heard that term a lot back in 2008 and 9. Excuse me. And what moral hazard is talking about is all this money flooding into corporations, and will they do the right thing with it? Or better put, if they know they're going to get bailed out every time, will they be less prudent in the future because it's almost like a spoiled kid, right? Well, if you're going to bail me out, I'm still going to do this bad behavior. So what I think is a little bit different this time, 2008-9, you can make a strong argument that there was really bad behavior by the banks, irresponsible lending habits and all this. What's happening right now is really no one's fault, right? I mean, the airlines, I don't think they could have seen this company coming. The restaurants certainly couldn't. The local bodega certainly couldn't see this coming. So I'm not sure if there's as much moral hazard here. But the question still remains, if the government does not allow the money to be used for buybacks, what does that mean? Well, that means there will not be buybacks. And that will, or that could somewhat temper the rally back because, moral hazard aside or politics aside, when a company buys back stock, it raises the stock price. It's a good thing for stocks. But that said, I think we're going to get through this both from a health perspective and economic perspective without the buyback. So I'm not too worried about that. So with that said, excuse me, I'm just kind of scanning through here. Let me just go up. I'm just trying to scan which one we've already answered and which one's not. I'll just take a couple of more here. Okay, this is from, must be a guess because I don't recognize the name here. I don't think anyway. Why have the Feds never bought back corporate bonds before? Okay, I guess they felt they never really had to. And I think you have to understand, it is such an aggressive move to buy back corporate bonds that I think the Fed back in 2008-9, when they were panicked, right? They were worried about what was going to happen with the economy. They chose not to buy back corporate bonds because they felt that was a line too far, right? Because that really is an aggressive move because now you have the government, taxpayer dollars, buying private debt, not public debt, but private debt. So that's an amazing thing. So the reason why they never did it before is probably the same reason why they were probably hesitant to do it this time, because it's an amazing step to use taxpayer dollars to essentially buoy up private debt. So the whole idea of capitalism, right, is survival of the fittest. If your company can't pay your debt, then you should go bankrupt, right? That's the premise of capitalism. But they're putting that aside, and that is that moral hazard argument again, putting it aside because, it really isn't any corporation's fault what's happening right now, for the most part, at least that I could see. So they're saying, look, it's not your fault, but we don't want you to collapse. We don't want you to fire your employees, and we want this economy to rebound as quickly as possible. So they never did before, for the same reason why I'm sure they were hesitant to do it this time, is because it's kind of crazy, right, to use public money to buy private debt. Okay, I'm going to take one more of these questions. This is from Tony. I feel like I'm doing a radio show. It's from Tony in Connecticut, sometimes Florida. In the view of recent events, do you see a need to do more hedging against losses in the long-term 10-year bucket for your retirees, 70-year-old clients? The answer is yes. We actually have been doing that. For a lot of you out there that have 10-year money with us, which most of you have some amount of 10-year money, we have been doing some hedges, and by hedges we would include that as not only option hedging for some of the larger accounts, but also structured notes and some of these fee-based index annuities, which frankly have done a pretty nice job in hedging out some of that risk. So that is what we do believe. So as much as we do have that line of demarcation, short-term is conservative, long-term is aggressive, and the 6 to 10 is somewhere in between. We do on a regular basis, and Tony, I can speak certainly for your account, we have taken measures to make it a little bit more conservative than, let's say, a 10-year plus account for, one of our younger clients, 35, 40 years old, kind of just in accumulation mode. So we have taken that into consideration. Okay, so good. The next round of slides, which we only have 3 more slides left, is about sequence of return risk. And I'm going to do these, and then I'll just do Q&A until I guess we're done with the Q&A, or until you guys are tired of hearing of me, whichever happens first. But sequence of return risk. This is super important. And I won't read this to you guys, but I'll leave it up there for a bit so you guys can't read it. Sequence of return risk is the idea that the series in which you get a rate of return in a portfolio, meaning year 1, 2, 3, 4, 5, the series that you get those returns, meaning good, bad, bad, or bad, good, good, that has a huge impact on the result if, and only if, you're taking money out. Okay, and I have two charts that I think do a nice job in explaining that, which are coming up next. But the whole idea of sequence of return risk is why we are so vigilant about making sure we know how much money you as a client need and when do you need that money, right? How much do you need in the short term versus intermediate term versus long term? And that is a very important part of the financial planning process, of the cash flow process. This actually here is a slide that I did at the New York Public Library recently. I did a whole presentation on what is financial planning. And, you know, there was probably 60 slides in that particular deck. This one here is the one that I felt was the most important and certainly the one that got the most attention. So sequence of return risk. Let me show you just two more slides. And hopefully you can see this okay. And again, I wish I had that highlighter feature. And it's just not really evident how to use it. So I'm going to walk you through this. This is a little bit easier with the highlighter, but it is what it is. Okay, so what you have here, I'll just go through the columns all the way on the far left of your screen. You have the years 1, 2, 3, 4, going all the way to years 25. So this is assuming a rate of returns over 25 years, 25 different rates of return. And then both of these columns start off with $1 million. And what's different between the column on the left versus the column on the right, as you will see, the column on the left starts off with a return in the first year of 5%, then the next year is 28, then the next year is 22, then the fourth year is -5, and so on and so forth. Looking at the column on the right, the first year return started off bad, -25, then the second year was -14, then the third year was -10, and so on and so forth. Now, what's interesting is the rate of return, if you look all the way at the bottom for both of these, averages, if you look to the bottom, 7.32%. 7.32%. So the rate of return for both of these is exactly the same. Oops, I'm sorry, I went ahead one slide. We should be here. The rate of return on average was 7.32% for both of these assumed rate of returns, right? Over the 25 years that's in this example. Again, the box on the left started off positive, +5, +28, +22. The box on the right started off negative. But at the end of the day, I keep hitting that. Okay, at the end of the day, sorry about that, folks. At the end of the day, the rate of return on average for both was 7.32%. What's also interesting is the standard deviation for both of these is exactly the same too. So what's also interesting, lastly, is the amount of money that both of these boxes delivered. At the bottom, you'll see delivered 4.28 million. Both of them exactly the same. So in this particular case, right, if you start off with a higher rate of return followed by lower rate of returns at the end, or the box on the right, if you started off with a low rate of return in the beginning and a high rate of return in the end, makes no difference whatsoever. Both the same. It's the same average rate of return. It's actually the same standard deviation, and it's the same dollar amount. Here's the problem though, and this is what my finger kept slipping onto, is the next slide. These are the same exact rates of return as far as the sequence. +5, +28, +22. Then on the right-hand box, -25, -14, -10, okay? And the average at the bottom, both of the averages were 7.32% each. But here's what's different. In this particular one, we folded in the idea of withdrawing. In this particular hypothetical situation, this household is withdrawing $50,000 a year, or 5% of the overall portfolio. Now look what happens when you enter in the idea of withdrawing money while these rates of returns are happening. This is going back to the idea of sequence of return risk. As you could see, the one on the box on the left that starts off with a higher rate of return ends up on the bottom with $2.5 million. But the box on the right, the unfortunate one, that had the unfortunate luck of having the negative rate of returns earlier, that person actually ran out of money in the 18th year. Ran out of money in the 18th year. So again, you have the same exact average rate of return, same exact rate of return. The only difference is the box on the left had the rate of return higher earlier on, and the box on the right had a rate of return that was lower early on. Bear with me for just one moment. I'm about to lose power. Excuse me, please. Okay. Well, it's like good old-fashioned live television, huh? All right, so I just had to plug in my laptop. I think we're back to good. All right, sorry about that. So again, this actually is important, so I didn't want to distract from this. So the idea that if you don't need to take out money, the rate of return or the sequence of those returns makes no difference whatsoever. However, if you're withdrawing money, the sequence of when you receive those returns makes all the difference in the world. So how this relates to our bucket theory, right? So for most of you here, unless we're just doing kind of ad hoc money management, like we're just managing this bucket of money, which we do for maybe 5 or 10% of our clients, but I would say 90+% of our clients, we're doing money management and financial planning integrated, which I think is the best way to do it. And that's why we're always solving for, and stop me if you've heard this before, how much money we think you need in the short term versus intermediate term versus long term. So that way, when you have your 10-year plus bucket, and if you're a client, and I could see the list of people on this call or this webinar right now, I promise you, most of you have a 10-year plus bucket with us. And as you know, it's down. It's down less today because of the rally, but it's still down. But if we've done our math correctly with you, if we've taken the time to truly understand how much money you need and when, and if we remain in sync with you with how much money you need and when, then that 10-year plus bucket should not need to be touched for 10 years. And what's going to happen is the market will go down and it'll go back up. And especially if you participated in some of those buys yesterday, it'll go up even faster. And that's the reason why we really, really focus on sequence of return risk, why it's so, so important. And that's all I really had to say about that as far as overview. And then I will now kind of go over to the Q&A, and I suspect there are some questions that may come up on sequence of return. And I'm going to look at that right now. Let me just see how we're doing on time here. 5:30. Okay, actually, we're going a little bit over than we thought. Hopefully that's okay with everyone. I suspect no one has restaurant reservations tonight, so maybe you have some time to kill. And I'm certainly glad that you're spending it with us a little bit at least. Okay, let me go to the questions. Okay. Bruce just had a quick question. For the sequence of return, are these actual market returns? These are just made up numbers, purely made up numbers. And they were designed just to show the impact of sequence of return risk and why it's important to firewall short-term versus intermediate term versus long-term money. Okay. Okay, this is from Hugo. Is this the right time to find good quality companies such as Ford? Yeah, you know, I started off in this business back about 26 years ago as a stockbroker. And you know, a lot of you have probably heard the story. I used to buy individual stocks. I mean, I can't even imagine doing that anymore, but that's what I did. And I spent a lot of time researching individual stocks, and I researched them a lot. And I used to look at insider trading and all kinds of other filings and tried to figure out what stocks to buy and which ones not. And what happened was some of those stock picks were great and some of them were horrible. And what I came to really believe is that the stock market is pretty darn efficient, which is why for the past 20 some odd years, we've been focusing on asset allocation as opposed to stock selection. So is this a good time to buy an individual stock? If you're a large investor and you have some, you know, I don't want to say play money because there's no such thing as play money, but, you know, 5% of your portfolio, if you want to take, I don't want to say flyers, but get a higher risk return potential with maybe 5% of your portfolio, makes some sense. But for the most part, I think over the long term, the success or failure of a portfolio is not, did I buy this stock or did I buy that stock, but rather, did I have the right amount in the stock market? Did I have the right amount in the bond market? Did I have the right amount in the high yield bond market versus the high quality bond market? I think those asset allocation decisions play more of a role than stock selection. Okay. Is the ballooning deficit going to depress the market? You know, it's funny. There was a little video clip I was going to add into this, and I'm not sure how many of you ever watched The Simpsons, and I used to quite a bit. I haven't seen it in probably years. But there's a great Homer Simpson's video clip. And if I remember, I'll put a link into this follow-up email. And it's Homer doing what Homer does, which is be incredibly irresponsible and making some really poor decisions just based on short-term desires, which kind of sounds like what's happening right now, perhaps with the Fed. Not to say that it's unimportant, not to say that they shouldn't be doing it, but it's definitely going to help in the short term. But your question is a good one. What's going to happen in the long term? And this very funny video clip that I like to watch shows Homer, again, making some very poor life choices that serve an immediate need. And then he says, boy, that future Homer, he's going to have a real big problem. I'm sure glad I'm not future Homer, right? So that's, I think within context, if I can find that clip, it's appropriate here. To answer your question, at some point, this deficit's going to be a problem, whether it's going to be a problem for us, for our kids, for our grandkids. But at some point, someone has to pay this bill. And, we're racking up some pretty big expenses here with this deficit. Is that going to impact short term? No, I think short term, the patient needs the morphine. The patient needs the medication. That medication right now is liquidity, and that's what the Fed is giving us. But at some point, that is going to be an issue. And how that's going to be addressed, at least for the time being, that's beyond my pay grade and perhaps beyond the context of this particular presentation. But I think it's a long-term issue. But I think the question then becomes, what's the alternative? Is the alternative let the economy tank right now? And I'm not sure if that's the answer either. Okay. Let's see here. Yes, that is my question. Okay, so looks like I answered that. There's a hi, Chuck. Hello. All right. I'm going to read this one. Why do you look so handsome and calm and not more stressed? Thank you, Fred. Well, I'm not sure about the handsome part, but I am fairly calm. And that's a very generous thing, Fred. Thank you. It's because we've seen this before. I have seen this before, right? I lived through 2008 and 9, not as a casual observer, not as a student, right? I mean, I was full on in the stock market, managing money, taking client calls, making allocation decisions like we've done. And, I've seen it. And back then, that was an incredible period of time. And all of us on this call today remember that time, I'm sure. It was an incredible period of time. And, back then it was common to say, we've never seen anything like this. How are we going to get out of this? And of course we did. And we had a fantastic 10 years afterwards. And I'm not sure if this is going to play out exactly that way, but I do believe it's going to play out in a way similar to that. Okay, just for time concerns, I'm going to try to answer just a few more questions and then perhaps just wrap this up. And if there's any questions I did not answer, I will certainly field them offline, and just feel free to shoot me an email because we have a bunch here and I know we're quite a bit over time. As a matter of fact, let me just take a moment now to say that I will send a follow-up email. There's a few parting notes here, and then I'll just stay on and answer questions. And if your question has been answered and you want to drop off, feel free to. I wouldn't be offended. But the main thing is to make sure that we are in sync, right? I've said that a few times. So if you feel for some reason we haven't been in sync recently, or your cash flow needs have changed, please reach out to me. We can do a phone appointment. We can do a video conference. I'm fully available this week, next week, whenever, and we can discuss that. But that's super important. Afterwards, I am going to send everyone an email. I'll put a link in for that New York Times article. And the other thing I did want to mention, I try not to send out too many emails because I think if you get too many emails, they start losing the impact. So if I send an email, it's probably a fairly important one. But I also recognize that, especially during these times, people want to get a little bit more interaction. So I'll be doing more stuff on social media like Facebook, Twitter, LinkedIn, and I'll send you links to get to those sites. And you can certainly follow us there. I would frankly appreciate it. It's kind of nice for our visibility to follow us on one or all of those. So Facebook, LinkedIn, Twitter. And what's also nice about that is I'll be doing more posting on those because of social media. I don't feel like I'm barraging all of you guys with a lot of emails. So if you want some more extra touches or kind of what am I thinking about today, I'll be posting probably at least every other day. Something I've been doing a lot of articles recently with Investment News and some other trade publications. I'll publish those on the social media. So after this presentation, sometime later tonight, once we wrap things up, I'll send everyone an email. And if you would please follow us on one or three of those, the Facebook, LinkedIn, or Twitter. I'd appreciate it. It's also good visibility for us. Share it with your friends, and that's something that we would certainly appreciate. So those were kind of my closing comments, but I will continue on to answer as many of these questions as I can. I do have a call scheduled already that I do need to get to in a little bit. So I'll probably be able to get to 5 or 6 more of these questions. But again, if I did not get to your question, please just email it to me later. I'll try to see if there's a way I can transpose these into an email. But I do want to make sure we get everyone addressed. So I'll kind of unofficially wrap up the presentation at this point. Thank you all very much for joining us. Hopefully for our first one, it went over fairly well. At least we got you guys logged on this time. That was pretty good. And I will send a follow-up email afterwards with those links that I had mentioned. Okay. So having said that, if you want to log off at this point, of course, feel free. If you want to hang on for a little bit, I do have a few more questions here I can try to answer. Okay. Starting here with Anthony, there's another one here. So assuming the economy shuts down for an extended period of time, for example, 6 months, to what extent would that influence your investment choices? Well, not so much the investment choices, but it would impact the asset allocation. So something that we are doing is not only placing limit orders to buy on some dips for long-term accounts, but also we're rebalancing portfolios. So if this really extends 6 months and we're just in full lockdown mode for 6 months, which who knows, it's a possibility. If that happens, I suspect the market would go down even further. And if the market would go down further, we wouldn't make any individual investment selections, but we would be rebalancing the portfolios. And whenever you rebalance, what happens is you're selling off the winners and buying into the losers. So under that scenario, Anthony, what I would imagine is the fixed income would continue to outperform equities. So we would be selling off some fixed income, buying equity. So the ratios stay the same. We wouldn't make any limit outright purchases, but we always want to keep those ratios together. And that really is the importance of rebalancing. Okay. Why have the Feds never bought corporate bonds? Okay, we actually touched upon that. Okay. Okay. Sorry, I'm just kind of scanning through the ones we did and did not answer. Okay, here we go. Okay, here's another one. This was from Marie. I've got another 10 years or so of working, not in a panic with my savings. As a matter of fact, I think I should take advantage of the down market and buy even more. You and me both. Yeah, so definitely for our 10-year plus portfolios, we think that's the right thing to do. And for most of our 10-year plus portfolios for accounts and clients that we feel are fairly aggressive, we did just that yesterday. So great minds think alike, and I completely agree with that. Howdy. All right. You know what? Just maybe scroll down. I think there's some more down here. Again, pardon me while I'm dealing with a new system here. Oh, great presentation and information. Thank you. You are very welcome. Thank you. Okay. And oh, here's one from Stephen. What would be the one ETF you would buy at this time if you have some dry powder? SPY question mark. We used to buy SPY. Right now we like IVV. If you want exposure to the S&P, simply because the IVV is cheaper. So that's what we like to buy right now for the S&P. Okay, that question has been answered. Okay. All right, we talked about individual stocks. I think some of these I've already covered. Okay. This graph is based on the S&P 500 or which index? That is actually based on the Morningstar index, and it's in the disclosure somewhere on that Morningstar slide, but it's a basket of stocks, at least as broad as the S&P, probably broader. Okay. All right. Yes, that's my question. Okay, looks like we addressed that. All right, I think we covered a lot of these. Wally, here we go. And Wally used to be in the bond market. So does the bond market represent an existential threat right now? I hope not. I know we focus on equities, but I think we did cover bonds quite a bit. And as I said a couple of times, and I'll say again because it's worth mentioning, the fact that the Federal Reserve is looking to and has purchased corporate bonds, and not only corporate bonds, corporate bond ETFs, like a real commercial product, speaks at least to, I guess, two things. Number one, your point, it's pretty scary when the corporate bond market locks up. But the counterpoint And the one that I would look at in an optimistic light is the Fed seriously seems to be putting its money behind where its mouth is, right, is the expression, and willing to do whatever it takes within their power. And their power is pretty vast to buoy up the bond market. Okay. All right. I'll pass that question. But funny, but thank you. Assuming the economy shuts down. Okay, we talked about that. All right. This is from Susan. Should someone who retired recently panic about their portfolio? Oh, I'm sorry. I think we covered that one. And again, Susan, I'm not sure if you're a client of ours, but you should reach out to me. I would not suggest panic selling at any point, and certainly no selling outside of the context of a plan. If you did a plan and perhaps you didn't plan properly in advance, but never too late, if the long-term plan says you should sell, then maybe you should, but I wouldn't do it as a knee-jerk reaction. Okay. Another question here. Don't you think many small businesses will fold and that unemployment will rise to high levels, causing the Fed to spend heavily to support the population? Yeah, I think that is possible. The question is for how long will this happen, right? So if the Fed has to buoy up the market for the next 2 years, I don't know how that can happen. Could buoy up the market for the next 3 to 6 months? I believe it can. Will there be some long-term consequences with inflation and deficit? Of course. But going back to that future Homer anecdote, that's unfortunately the category that falls under. Okay. All right. I think we answered most of these here. All right. Just give me a few more moments. I think we see some people signing off right now. Okay. So these are, some thank yous. You guys are very welcome. Thank you guys all for joining. Hopefully this was a good use of everyone's time. Okay. Here's one from Paul. Hi, Chuck. How will the oil price battle affect the market? There's an adage in the commodities markets regarding oil prices, and what they often say in those trading pits, although I don't think they're even pits anymore, online trading, I suspect, but the best solution for low oil prices is low oil prices, which means if it stays low long enough that the prices will ultimately go up, because that's just how it works. So, this little sort of side drama on top of the virus is what's happening between, Saudi Arabia and Russia with their head-to-head battle and over the oil prices. I think that will resolve itself just because at some point someone has to flinch, because oil at these prices, no one can make money. Not even the most efficient producer of oil, let alone the lesser efficient producer of oil. They just can't sustain, they can't survive at these levels. So the market is going to have to bring that up, or they're going to go out of business. And if they go out of business, then the market price will go up. So I think that's how that's going to happen. Okay, we talked about how this compares to 2008. All right, algo trading, we talked about that. 6 to 10. I think what it is, I'm not clicking done on these. So these are kind of repeats. Okay, good. Stop losses, we talked about that. And okay, good. I think we answered all of them. I don't think there's any unanswered questions. Okay, some thank yous. You guys are, again, very welcome. Thank you guys all very, very much. I really appreciate you joining us today. And I think we have all the questions answered, unless I deleted someone by mistake. But looks like we're all done for today. So folks, thank you all truly very much for joining us. I will send everyone an email as a follow-up with some links. Please do consider following us on Facebook, Twitter, LinkedIn. The exposure for us is good, and frankly makes me feel good when we get some likes, other than from my wife, Carmen. So that'd be great if you guys could do that. That would be truly appreciated. And also, when I send out that email, please reply back with honest feedback on how you felt this webinar went. Was it good? Was it bad? Was it too long, too short? What you liked about it, what you didn't like about it. One thing for sure, I want to get that highlighter feature working. I think that would have helped on explaining some of the slides. But do please give us some feedback, good, bad, and the ugly. That's the only way we can make these better. And we certainly look forward to doing more of these presentations virtually while we need to. And we are all very, very much looking forward to the next ones we have at the Capitol Grill, both in Stamford and New York City, when we all get the green light. So I think we've addressed all the questions. Those were all the topics I wanted to cover. And so I'm going to sign off. So again, thank you all truly very, very much. I appreciate it. And if there's something I didn't cover, or if there's a personal question relating to your own account more specifically that you want to ask me offline, please do not hesitate. Again, thank you very much. And this is Chuck signing off from Sovren. All right. Thank you all very much. Have a great night, and I hope everyone stays well and healthy. Bye-bye.